On a little bit of common sense. Today, I want to explain in simple terms how interest rates rise and fall depending on whether people buy or sell treasury bonds in the open market, otherwise known as the secondary market. Okay. I want to do that because last Wednesday we had an interesting enough little event happen. The Federal Reserve, we are told, lowered interest rates by 1/4 of a percentage point. And people will think that the interest rates fell by 1/4 of a percentage point, which would be good perhaps if it did. However, the interest rates on that day, Wednesday, Thursday, Friday, and today, each and every one of those 4 days, interest rates actually went up instead of going down. And you might say to yourself, can you explain to me how that could be possible? And indeed I could, and now I shall. All the Treasury debt is in the form of United States Treasury bonds, which are simply IOUs, sold to investors who will pay money to buy them to get a coupon or an interest rate return per year. And at the end of their lifespan, which might be 5 years, 10 years, 30 years, whatever, they will be paid back the principal. And now they'll have the principal and they'll have the coupons, which is the interest, and they will be happy. Okay. Let's say a fellow had purchased one of those bonds. He would have paid $1,000 for that bond. And the day he bought that bond, it was sold to him with an interest rate of 5%, which means he will be getting every year for the next 10 years $50 of a coupon or a return. And at the end, he'll get his $1,000 back. As far as he's concerned, if he holds that to maturity, he's always going to get 5% and he is happy. Let's say, for example, though he needs some money and he decides to sell that bond. He's hoping to get $1,000 and he's going to tell the other fellow, this will pay you 5% per year. The fellow mightn't want to give him $1,000. Let's say instead he wants to give him $970 instead of the 1,000. Well, the guy that's selling doesn't want to take that price, but after a few days he decides, well, I'm not going to get any more for it, and I got to take what I get because I need the money, and he will sell that bond for $970. Now the calculations are different from the guy that bought the bond. The guy that bought this bond will still be paid the $50 per year coupon, regardless of how much he gave the other fellow for the bond. But from his perspective, he has paid $970 and he's getting a return of $50 per year on his 970. If you divide 50 by 970 to calculate the interest rate, well, shiver me timbers, it comes out at 5.15%. So now, from that day onwards, with millions of people doing the exact same thing, the yield on the 10-year Treasury bond is no longer 5%, it is 5.15%. Okay, 5.15. Let's say, for example, the guy didn't get 970, he instead got 960. He's still getting the $50 return every year. This guy's situation is 50 divided by 960, which turns out to be 5.2%. So now the interest rate is 5.2%. God forbid the price of the bond went down to $900. You're still getting the 50. Divide 50 by 900, and you will come up with 5.55%. So that constant trading in what's known as the Treasury secondary market will determine each and every minute of each and every trading day what the actual interest rate on the 10-year Treasury bond is, and it's the exact same for all the other bonds. The calculations might be a little bit different, but that is how it works. What you need to remember, if you're not a super brain that can do the calculations, you need to remember that if the price of the bond that already exists, paying the set agreed coupon or interest payment every year, If the price of the bond goes down, the effective interest rate will rise. And vice versa. If there's a big demand for bonds, the fellow might end up selling that bond, we'll say for $1,030. In that situation, divide 50 by 1,030. The interest rate then in that situation is 4.85%. So the interest rate has fallen if the price of the bond rises. It's an inverse relationship. And that is how the interest rates is set on the treasury markets each and every day. Okay, so far so good. So last Wednesday, the announcement was that the Federal Reserve will drop the interest rates by 0.25%. First and foremost, the Federal Reserve only impacts one particular interest rate. It is what's known as the overnight interbank interest rate. It's known as the federal funds or the Fed funds. That is the interest rate banks will charge one another when they have to borrow from one another overnight, money if they need it, and vice versa, to balance their books at the end of the trading day. So it's a very short term rate. And they don't even set that figure. They instead set a target range of 0.25%. So if they want that to be 4%, for example, they will set a target between 4 and 4.25. The market itself back and forth will determine the exact interest rate. And if the Federal Reserve will see that it's going above its target range, it will go into the market and purchase short-term securities. Okay? That'll put money into the system. That will raise the price of these bonds. The raising of the price of the bonds will drop the interest rate. And in that way, either adding or subtracting money by buying or selling securities, they will be able to keep that short-term rate in that trading range. And that works. Okay. So when they dropped the short-term target rate, the Fed funds rate, the calculation in the marketplace was that the Federal Reserve was going to be more accommodating. They like to use these words, accommodating, which means that they will supply as much liquidity as necessary into the system to keep interest rates low. But of course, more liquidity equals a lessening of the value of the dollar and also an increase in the money supply, leading to more inflation. Inflation is bad for bonds. So a person that's holding a 10-year bond might say to himself, I will get less value now when this bond matures than I would otherwise. So I am going to sell my bonds. I've had a good run. The selling of those bonds will then raise the interest rates. And that is exactly what occurred in the 4 days thus far after the Federal Reserve dropping the Fed funds rate target by 0.25%. So that is what happened in the 4 days. This is not a good sign for the economy. It's not a good sign for the financial system either, because the financial system is at a breaking point. As an aside, anybody that watches the gold and silver market, gold is setting record highs practically each and every day. Today, gold went up by another $72 per ounce because people are losing faith and confidence in the United States currency. Anyway, that is just an explanation. We are going into rough times. I'm not giving anybody advice. But if you are on the Titanic on the date of April the 14th into the 15th, the advice would be very simple. If you're on that Titanic, you would try to get off. Thank you very much.